Hey, what's up everybody? It's Dan again, and welcome to my channel. This is a place where small business owners like you can come and get the advice and support that you need. If you like my content or you find it useful, please subscribe to my channel and be sure to click the like button. Today's video is going to be the second in the finance and accounting series for a small business. In the first video, we covered raising money for your business through debt instruments. In today's video, we're going to talk about raising money for your business through equity instruments. Let's talk a little bit about investor funding versus debt funding. Now, typically, investor cost of capital is going to be greater than debt cost of capital. What do I mean by this? So let's say you borrow money from a bank and the interest rate is 7%. Well, the debt cost of capital is going to be 7%. Or if you buy things on a credit card and the interest rate is 11.99% and you don't pay the credit card off, your debt cost of capital for that particular instrument is going to be 11.99%. Now, typically what you can expect from an investor to justify the risk is between a 15 and 20% expected return on their investment at an absolute minimum. Second thing is cash outflows for paybacks for each instrument. Now, typically whenever you get a loan from a bank, within a month after securing the loan and having the funds deposited in your account, you're going to get a regular monthly amortized payment. So you're going to get a payment of X amount that's going to flow out every month, and you're going to be able to predict that for the business. For a cash flow payback, typically investors don't expect a return right away, but eventually they're going to expect some sort of regular structured payments on their or return on their investment. Next thing is whenever you take on a debt instrument, you have no exchange of ownership in the business itself. Whenever you take on an investor, you're exchanging equity in the business or ownership in the business that's proportionate to the amount of money they invest to the overall value of the company. So let's say the value of the company is $100,000 and you take a $20,000 capital injection from an investor. Typically, in this case, they would take 20% of the business or 20% ownership of the business. You also have accountability concerns for an investor. So be ready to answer to an investor. Be ready to report to an investor. Sometimes investors have difficult questions and they're going to press you for information. So be prepared to be accountable to your investor. Some investors are going to want to participate in the business in the future. Some are going to want to be what's called a strategic investor versus a financial investor, and I'll cover that in the next slide. But typically, a strategic investor is going to want to put input into the business, and a financial investor could possibly want to inject more money in the business if you give that person a good rate of return. So we're going to talk briefly about things to consider when taking equity investments. Number one, you need to consider the cost of equity funding versus debt funding. As I said, expect typical equity expectations or return expectations of between 15 and 20% typically at a minimum. Next thing you're want to do is identify and attract the appropriate investor for your business, and then you're going to want to manage the expectations of that investor. Be realistic with the investor. Be truthful with the investor. Don't sugarcoat things. Don't overinflate and don't underinflate things for the investor. Be transparent. When the investor comes, they're going to do their due diligence and they're going to know whether you're being truthful or not, if they're worth any salt or they have experience in investing in businesses or not. This one here is the most important. Make sure that you hire an experienced local business attorney to draw up a contract. And I can't stress this enough. This is going to be one of the most important things, as I said. And also, when I talked about number one, about considering the cost of equity funding versus debt funding, this is part of your cost. A good business attorney can typically run between $250 and $500 an hour and expect to go back and forth between your counsel and your investor's counsel at least several times. So you're going to rack up a significant legal bill in this, but it's good. The cost is going to be worth it in being able to manage the expectations of both sides. Fourth one is classifying your investor. And what I'm referring to here is two types of investors. I'm talking about a strategic investor versus a financial investor. A strategic investor is going to be more of a hands-on. They're going to want to say in your business. They're going to want to be more involved. They're going to maybe possibly want to work with you on a daily basis. They're going to possibly, if you have a corporation, want to be on your board of directors. A financial investor is going to be more hands-off. Typically, they're going to want to put money into the business, and they're going to want to have some sort of return, but they're not going to want to have a say in how you operate the business as well. Fifth, you're going to be expected to report to your investors on an absolute minimum on a yearly basis, at least for tax purposes. But I recommend that you get in the habit, or you have the expectation of reporting to your investor on at least a quarterly basis. This is what you see in a lot of public Wall Street companies, is the quarterly reports. So expect to give a quarterly report to your investors if you're going to take on an investor base. Last thing is you want to define parameters for an exit strategy, both for you and the investor. In the event that you have an expected or unexpected divestiture from each other, you're going to want to have some sort of heuristic in place about how this is going to happen. Last things I'd like to cover is examples of different investor strategies. Some investors are going to want longer term, some are going to be shorter term. Again, this is all going to be relative to the type of business and type of investor that you have. Some investors are going to want to have warrants. And what a warrant is specifically, it's a type of option contract that starts out as a debt instrument. So for instance, just say you have an investor that wants to extend you a line of credit of, say, $25,000. And that investor is going to have an expectation that that line of credit is going to be paid back within a year with a $5,000 interest, and that's going to be, say, $30,000 total. If that instrument is not paid back in a year, the investor typically in a warrant has an option to convert what's left on that debt instrument, or a portion or all of that debt instrument, into equity and take ownership in the business as well. So it basically starts out as debt, and if the debt isn't paid back, it typically converts to an equity share in the business itself. The next thing is a royalty. Royalties are typically reserved for instances where you have something that you manufacture, distribute a large amount of sales based on a unit cost, and for each unit that you sell or bring to market, the investor's typically going to want to take a royalty. Royalties are typically a top line take from sales, and that's going to be more impactful than, say, a bottom line take or a percentage of profits. So keep that in mind as well. Scalability. Every investor practically is going to look at scalability. What's the potential and the vehicle for growth and the means of growth for the business? Is the business going to start out here and then the business is going to grow and expand? What's the scalability like? What's the time frame for the scalability? How big is it going to get? Is the business going to be here and it's going to grow to here someday? Acquisition target. Is your business a potential acquisition target? Do you have some sort of intellectual property that you can grow and develop and build a lot of value to where you can be noticed by a larger competitor and acquired by a larger competitor, and that's going to have a significant return on investment for both you and the investor. And the last thing is, some investors, depending on the type of business, type of investor, some investors are going to want to have a strategy of someday taking your company public. So with all that, I hope you have an understanding, or at least a broad understanding, of what it means to get an investor or have an equity investor versus a debt instrument from our last video. If you have further questions, or you would like to book a coaching call with me, visit me at www.sbeally.com. There's a lot of free educational resources on my site. Please check those out. And don't be afraid to book a free 15-minute coaching call with me. And we can talk a little bit about your business, learn about your business, and we can see if there's any way we can help. Please don't reinvent the wheel. I want you to draw on my experience. Come visit me at www.sbeally.com. And with that, I'll see you in my next video.